Let me tell you about Marcus Chen. Successful tech entrepreneur, 42 years old, sitting on a comfortable seven-figure portfolio. March 2020. Silver's trading at $12 an ounce. Marcus sees the writing on the wall. Unlimited money printing, stimulus checks flying out the door, inflation about to explode. He knows silver's going to the moon. So he doesn't just buy silver, he buys silver on margin. 50% leverage through his brokerage account. Turns his $200,000 position into $400,000 of silver exposure. Genius move, right? Silver rockets to $29 by August. Marcus is up massive. He's telling everyone at dinner parties about his brilliant trade. Then September hits. Silver pulls back to $26. No big deal, still up huge. But his broker sends him a margin call. The pullback triggered his maintenance requirement. He needs to deposit $30,000 immediately, or they'll liquidate his position. Marcus scrambles, wires the money. Silver bounces back to $27. He breathes easier. October comes. Another pullback to $23, another margin call, this time $50,000. He wires it, but now he's stressed. Can't sleep, checking prices every hour. November. Silver drops to $21 on a technical sell-off. Margin call for $75,000. Marcus doesn't have it liquid anymore. He's already wired $80,000 to meet previous calls. His broker liquidates his entire position at $21.50. Marcus just lost $140,000 on a trade where silver never even went below his entry price for more than a few weeks. And here's the kicker. By July 2021, silver hit $28 again. If Marcus had just bought physical silver or even unlevered futures, he'd have been up $120,000. Instead, he's down $140,000. That's a $260,000 swing because of one decision: buying on margin. I'm seeing this story play out right now across the silver market. And I need to walk you through exactly what's happening. Because if you're thinking about using margin to buy silver, or if you're already in a margined position, you need to understand the mechanics of what you're actually doing. This isn't about whether silver's going up. I think silver's going to $50, maybe $100 over the next few years. This is about whether you'll still be in the trade when it gets there. Because margin is the difference between making life-changing money and getting completely wiped out on a trade you were right about. Let's start with what margin actually means in the silver market, because most people don't fully understand the mechanics. When you buy silver on margin, you're borrowing money from your broker to control more silver than you could afford to buy outright. Sounds great in theory. If you have $50,000 and you use 50% margin, you can control $100,000 worth of silver. Silver goes up 20%. You make $20,000 instead of $10,000. You just doubled your returns. But here's what they don't emphasize. You also doubled your risk. And in silver, that risk isn't theoretical. It's practically guaranteed to materialize because of how this market moves. Silver is the most volatile major commodity on the planet. It makes oil look stable. It makes Bitcoin look calm. I'm talking about regular 5 to 8% moves in a single day. 10% swings in a week are completely normal. During the March 2020 crash, silver dropped 33% in 2 weeks. During the 1980 Hunt Brothers squeeze, silver went from $6 to $50 in a year, then crashed back to $10 in 2 months. In 2011, silver went from $26 to $49 in 3 months, then dropped to $26 in 5 days. 5 days. If you were on margin during any of these moves, you got obliterated. Not because you were wrong about silver's long-term direction, because you couldn't survive the short-term volatility. Here's how the margin call mechanism actually works, and why it's so dangerous in silver specifically. Let's say you buy $100,000 worth of silver with $50,000 of your own money, and $50,000 borrowed on margin. Your broker requires you to maintain at least 30% equity in the position. That's called the maintenance margin. So your equity needs to stay above $30,000. You start with $50,000 equity, so you've got $20,000 of cushion. Sounds like plenty, right? Now silver drops 15%. Happens all the time. Silver dropped 15% in September 2023, dropped 15% in March 2023, dropped 15% in June 2022. Your position is now worth $85,000. You still owe $50,000 to your broker. Your equity is $35,000. You're still above the $25,500 maintenance requirement. You're fine. but silver drops another 10%. Now your position is worth $76,500. You still owe $50,000. Your equity is $26,500. You're below the maintenance requirement of $22,950. But your broker doesn't care about percentages anymore. They want you back to safe levels. They issue a margin call for $10,000. You have 24 to 48 hours to deposit it, or they liquidate your position. And here's the truly brutal part. They liquidate at the worst possible time. Margin calls happen during crashes. That's when volatility spikes. That's when prices are at their lowest. That's when you least want to sell. But you have no choice. Your broker isn't asking your opinion. They're protecting their loan. They sell your silver at $22 when you bought it at $29, and you just locked in a 24% loss on a position that might have recovered to $35 6 months later. You were right about silver. You just couldn't stay in the trade. Now let me show you what's happening in the silver market right now that makes margin especially dangerous. We're in the early stages of what I believe is going to be a historic silver bull market. But it's not going to be a straight line up. It never is. And the path from here to $50 or $100 silver is going to be littered with the corpses of margin traders who got shaken out. Look at the setup. Silver's around $32 right now. It hit $34 in October 2024, pulled back to $29 in November, bounced to $32 in December. That's a 17% swing in 2 months. Completely normal for silver. But if you were on 50% margin, that pullback from $34 to $29 triggered margin calls for thousands of traders. I know because I saw the volume spikes on those down days. That's forced liquidation. Those traders are out of the market now. And when silver goes to $40, they won't be in the trade anymore. The fundamentals for silver are absolutely explosive right now. Industrial demand is at all-time highs. Solar panels, electric vehicles, 5G infrastructure, AI data centers. Every major technological trend requires massive amounts of silver. Solar panel installations alone are projected to consume 85 million ounces this year. EVs use twice as much silver as traditional cars. The average EV uses 25 to 50 grams of silver. We're going to produce 25 million EVs this year. That's 625 to 1,250 tons of silver just for EVs. Investment demand is surging. Silver Eagle sales, ETF inflows, retail buying in India and China. Central banks are diversifying into silver alongside gold. The supply side is constrained. Primary silver mines are barely profitable at $32, and most silver comes as a byproduct of copper, lead, and zinc mining. When those base metals slow down, silver supply drops. We're heading into a supply deficit that could last years, but none of that matters if you're on margin, and silver drops from $32 to $27 next month because the dollar rallies, or the stock market crashes, or some technical selling hits the COMEX. You'll be out of the trade before the real move happens. And that's exactly what the big players want. Let me explain how this market actually works, because understanding the structure is critical to understanding why margin is so dangerous. The silver market is dominated by a handful of large commercial banks, JP Morgan, HSBC, Scotiabank, a few others. These banks are short silver futures on the COMEX. They're not short because they think silver's going down long term. They're short because they're hedging their physical silver holdings and providing liquidity to the market. But they also know how to manage their positions. When silver rallies and small speculators pile in on margin, these banks don't panic. They wait. They know silver's volatile. They know a pullback is coming. And when it does, they know exactly what happens. Margin calls force liquidations, which pushes prices lower, which triggers more margin calls, which forces more liquidations. It's a cascade. The banks cover their shorts at lower prices, the margin traders get wiped out, and then silver resumes its uptrend. This pattern has played out dozens of times over the past decade. Look at April 2011. Silver went from $31 to $49 in 3 weeks. Margin traders were euphoric. Then, May 1st hit. Silver dropped $6 in 1 day. May 2nd, another $4. By May 5th, silver was at $35, a 28% crash in 4 days. Every single margin trader who bought above $40 got liquidated. Gone. And where's silver today? $32. Still hasn't recovered those highs 14 years later. But the point isn't whether silver eventually goes higher. The point is that if you were on margin in April 2011, you lost everything in May 2011, and you weren't around for whatever comes next. Here's what most people don't understand about margin. It's not just about the math. It's about the psychology. When you're on margin, every price tick matters. You're not thinking about where silver will be in 2 years. You're thinking about whether you'll get a margin call tomorrow. You check prices constantly. You can't sleep. Every down day feels like a disaster. Every rally feels like relief, not opportunity. You're not investing anymore. You're gambling. And you're gambling with borrowed money, which means you're gambling with your broker's risk tolerance, not your own. I've watched this destroy people. Not just financially, but emotionally. I know a guy who bought silver futures on margin in 2020 at $18. Silver went to $29. He was up huge. He didn't take profits because he was convinced it was going to $50. Silver pulled back to $22. Margin call. He deposited more money. Silver went to $26. He felt vindicated. Then it dropped to $21. Another margin call. He deposited everything he had liquid. Silver bounced to $24. He was exhausted, stressed, fighting with his wife about the money. Then silver dropped to $20 in September 2022. Final margin call. He couldn't meet it. Liquidated at $20.50. Lost $85,000. And silver's at $32 now. He was completely right about the direction. He just couldn't handle the volatility on margin. Now let me talk about something that's relevant if you're thinking about this from a retirement perspective. If you've got $100,000 or more in retirement accounts and you're concerned about inflation, dollar debasement, the kind of monetary chaos that makes silver attractive, there's a way to get exposure to physical precious metals inside your retirement account without any margin risk whatsoever. It's called a gold IRA, and it works with silver too. Basically, you can roll over funds from an existing 401k or IRA into a self-directed IRA that holds physical gold and silver. No leverage, no margin calls, no broker risk. Just physical metal in a secure vault, owned by your retirement account. I put together a free guide that explains exactly how this works, what the rules are, how to avoid tax penalties. It's in the description if that's relevant to your situation. Worth looking at if you want precious metals exposure, but you want to sleep at night. Anyway, back to why margin is so dangerous right now specifically. We're at a unique moment in the silver market where the long-term setup is incredibly bullish, but the short-term path is going to be volatile as hell. Think about what's happening in the world. We've got $35 trillion in U.S. debt, growing by $1 trillion every 100 days. We've got the Fed that printed $5 trillion in 2 years and is now trying to figure out how to unwind it without crashing everything. We've got BRICS nations actively working to reduce dollar dependence. We've got industrial demand for silver that's structural and growing. We've got a supply deficit that's real and getting worse. All of that points to much higher silver prices over the next 3 to 5 years. But we've also got a stock market that's at all-time highs and could correct 20 to 30% at any moment. We've got a dollar that could rally if there's a global crisis and everyone runs to safety. We've got a COMEX that's still dominated by paper trading and can be manipulated in the short term. We've got technical levels that will trigger algorithmic selling if they break. All of that means silver could easily drop from $32 to $25 or even $22 in the next few months, even if it's going to $50 in the next few years. And if you're on margin, that drop from $32 to $25 will wipe you out before you ever see $50. Let me give you a specific example of how this could play out. Let's say the stock market crashes 25% over the next 6 months. Initially, silver drops with it. Everything sells off in a liquidity crisis. Silver goes from $32 to $24. If you're on margin, you're liquidated. But then, 3 months later, the Fed panics and announces QE5, another $3 trillion in money printing. Silver explodes from $24 to $45 in 6 months. You were completely right about the trade. Silver went from $32 to $45, but you weren't in it. You got stopped out at $24 because of margin. The guy who bought physical silver at $32 and held through the crash, he's up 40%. You're down 25% and out of the trade. This is why the smart money doesn't use margin for silver. When you look at the big institutional buyers, the family offices, The sovereign wealth funds, the billionaires who are accumulating silver right now. They're buying physical. They're buying unlevered positions. They're buying with money they can afford to hold for years. They're not trying to maximize short-term returns with leverage. They're trying to preserve wealth and position for a major monetary shift. They know that silver's going higher, but they also know the path is going to be volatile, and they're not going to let short-term volatility shake them out of a long-term position. Think about Ray Dalio. He's been talking about the end of the long-term debt cycle, the need to diversify out of dollars, the importance of gold and silver. You think Ray Dalio is buying silver on margin? Hell no. He's buying physical, storing it in vaults, and planning to hold it for a decade. Think about the Chinese government. They've been accumulating silver for years. You think they're using leverage? No. They're buying physical by the thousands of tons and storing it. Think about the Hunt brothers back in 1980. Okay, bad example. They used massive leverage and got destroyed. But that's exactly my point. Even with billions of dollars and a legitimate thesis about silver, leverage killed them. Here's another angle most people don't consider: counterparty risk. When you buy silver on margin, you don't actually own silver. You own a contract with your broker that gives you exposure to silver's price movements. But that contract is only as good as your broker's solvency. If there's a major financial crisis, which is exactly the scenario where silver would go to the moon, your broker might not be able to honor that contract. We saw this in 2008. Lehman Brothers collapsed. MF Global collapsed in 2011, and customer funds disappeared. If you're on margin with a broker that goes under, you might not get anything. But if you own physical silver in your possession or in a secure vault, you have an asset that exists regardless of what happens to the financial system. Let me tell you about the mechanics of a short squeeze in silver, because this is what everyone on margin is hoping for. They're thinking, if silver squeezes, I'll make 10x on my margin position. And yeah, theoretically, if you time it perfectly and silver goes from $32 to $100 in 3 months with no pullbacks, you'll make a fortune on margin. But that's not how squeezes work. Look at the GameStop squeeze in 2021. It went from $20 to $483, but it didn't go straight up. It went from $20 to $75, back to $40, up to $150, back to $90, up to $350, back to $200, up to $483, then crashed to $40. If you were on margin,